Hi everyone, it's Mark here at Teslary, and Tesla closed very red today. $220.11 was that closing price, or a drop of $22.57 per share, 9.3% from yesterday's close. And we kind of expected it, right? It's typically how Tesla's price action works, where it would sell off a little bit in the after hours as a reaction to the earnings call, and throughout the rest of the day, it would just completely sell. And that's essentially what it did. And, it tried to find a base somewhere around where it closed. But in the after hours trading, what you don't see here is that it went back down to around $217 a share, with the rest of the market kind of selling off too. And also with a relatively, kind of adjacent sector doing very, very poorly in after hours quarterly earnings reports. That would be the solar sector, solar panels and insulation. And I'll just show that to you real quick. This is Solar Edge, who reported, and they dropped a considerable amount, about 20-something%. So they're really no different than Tesla in that respect. And this was because of interest rates. And the thing about solar panels and the insulation for them is that they're a pretty big ticket item up front. Maybe you want to put solar panels on your home. Maybe you don't have the ability to get a subsidy. The thing is, do you want to purchase a big ticket item on high interest rate if you need to finance it? And so it's kind of in the same boat that Tesla says they're in. If you remember the earnings call, Elon was really going off about interest rates for about half the earnings call, even in questions that didn't really relate to interest rates. But yeah, regardless of that, let's take a look at. Let's go to Tesla again. And we were talking about what? We were talking about a lower EM on the week of $227.30 or 50 cents. And it kind of broke below that pretty much immediately. And so that kind of it really makes you question what the street was thinking when they only were anticipating a 4.7% move for the week. And that's really consensus. That's what, that's how that's how options worked. So even if you had puts at the beginning of the week, they're actually paying off pretty well. Even with any volatility crush, the move is real big, and puts were definitely doing decently. I think even with a volatility crush on my 220s, I want to say it was up like 300%, something like that. But we knew this was going to happen. And the reason we knew is because the pattern is just so similar to what we saw from the spring. And you can see that here. It's just a smaller version of it because the spring played out much quicker. This is 3 months. Okay, it's not quick. And this is like 4 months. But it's been very long consolidation. And so it would make sense the move would be pretty violent. And it broke down through the trend line. It broke down through our lower EM. It broke down much further than I thought, but you got to kind of put it in a different perspective. If we think the move for earnings is typically around 10 to 12% after the earnings comes out, then you figure that you should count it on the day, of earnings. Well, if you want to count it on the day of earnings, it would be something like over here. And if we were to measure it from the day of earnings, then this is about an overall drop of around almost 14%, but closing at, like we said, around 12%. That's typically the move that you see for Tesla's earnings. We could look at the earnings from the spring, which had kind of the same type of it didn't have a strong sell-off on the day of the earnings though, right? So the day of the earnings, it gapped down but got bought back up and closed a little bit lower. But if we were to kind of measure out to like a local bottom, it was 11% on a local bottom for the earnings back in spring. So this is kind of known. So if we were to kind of measure just the gap down was 5.6%. And then from the highest point to the lowest point locally, around another 5.3%. We can take a look at it on this earnings action. So if we were to measure the gap is about 7%, and then it sold off another from intraday high. It sold off almost 6%. So you can see it gaps down and it just keeps on selling. Now, is this just isolated to two of these quarterly reports? Maybe we can check out another one and see. So here's another earnings report. And this one, it dropped almost 10%. It got bought back up a little bit, and then it just closed near the low, and then it made another low on the week after. So that's the question that we want to know now. If we have to kind of consider the macro context, because the interest rates are so much higher than they were any time in the past couple of years. So it's hard to say like, oh, will this happen again? Well, it could. But let's measure the one from July just to refresh our memories. The drop in July, if we want any, this is not any fun, but this was a 3.3% gap down. And then by Thursday morning, let's see, this Thursday morning, this is Friday morning, it dropped 12%. And that's just very typical. So what happens on the day after? That's kind of what we want to know, right? That's what everyone wants to know. And we can just look. I mean, we'll just look back at these last 2 quarters and see what happens. So here is the open at Friday. So the Friday has a little bit of sell-off. So it looks like it goes down. How much does it go down? Like a couple percent? It goes down like 2% in the morning. And then it gets bought up. And by 1:30, it gained 4.4%. Now, I think what this move is to get people out of their position, right? So the whole point is you have earnings on a Wednesday night, and then you have Thursday. Everyone's, kind of absorbing the reaction to this earnings report, trying to decide what to do with Tesla. And like I always say all the time, Thursdays are just perfect setups for Fridays. So if you know Tesla just dropped like 12% one day, dropped like another 4% the other day, or like it's not a good look, and you figure like, when does it find a little bounce? When does it go up a little bit? So you might throw a little gamble and buy some calls on Tesla on Thursday. They're pretty cheap, right? And then what the market wants to do is get you out of those calls, right? So it's going to get you out of those calls. So it sells off in the morning. So this is the sell off right here. So it'll sell you off in the morning, and then it will get bought up. So if you stayed in, lucky, maybe you get a decent play. But really, yeah, it might be a 5% move from the bottom of that day, but it's only a move of about 2% from the day before, right? And what happens for the rest of the Friday? And they just de-risk into the weekend. This is another thing that these last 2 quarters don't really have. Like, I know last year we had the Ukraine war, so you can kind of give the early parts of last year some war context. But now we have context again with a war in the Ukraine, and we have a war between Israel and in the Gaza area against Hamas. So there is this. You got to anticipate it's going to happen again. Even though the VIX is really high already, the VIX is like over 20, which hasn't happened in like half a year. You can be positioned, and people might be positioned going the weekend. Obviously, people are, like, everyone's holding stock, but they're going to have to make a decision. It's going to be, do you hedge like we did on last Friday? That's why the VIX was up 20% on last Friday. It was simply people buying so many puts, trying to get hedged up for like an escalation of the war. Now we're going to a weekend again where we have a long weekend, not really long, but like through 2.5 days of you can't do anything about it. And what do? Right? Are you going to hedge? And are you going to sell? Do you really want to hold over the weekend? And that's the kind of the unknown factor. So even though this last quarter in July where it sold off a lot, is that bounce going to be sustainable? Or again, at the end of the day, it fades even more going into the close. Let's look at the quarter before that, so we can try to see what happened on the Friday after. So here's the drop. It's a drop, and by Thursday at the close, it was a pretty considerable overall drop of 10.5%. What happens in the morning? Let's kind of like widen this and zoom in and see what we got here. So this is the Friday morning, and you can see it has a little bit of a pump. There's a pump there, and then it's kind of violent in the morning, really. But wait, let's make sure. So by the middle of the day, by 2:00, really, it was only a 2% gain again. So that's 2 quarters in a row where the bounce was a 2% net gain. Maybe it would be more of a gain from the morning low, but really it was a 2% gain. And what happened for the rest of the day? It was flat and sold off basically. So it's really not that of an impressive day. And the reason for that is you might get a move in the morning. You might want to get out of your position once you capture that move, because what do we have tomorrow? Tomorrow's OPEX. It's going to be OPEX expiration. So number one, you have to watch out for is the morning expiration of SPX options. So the SPX has expirations at 9:15 a.m. and after the close at 4:15 p.m. So traders have to kind of work. They have to do like double the work. They have to make sure that they get their 9:15 a.m. expiry to the perfect, max pain point, whatever that's going to be. And I really don't know what it's going to be for the SPX. And they're going to have to then redo all their work and try to figure out what's going to happen for the max pain of the actual afternoon close. So, and that's going to evolve a lot. I say it all the time. Like, you can look at options open interest and options volume for tomorrow, but that's only, working up to whatever was purchased up to today. And we know what happens on the actual Friday is the volume of these options like triples throughout the day. So it can really affect where that max pain point would be at. And so we can look at that real quick. Let's go over to the browser and sorry about that. Transition. This is the Tesla stock. Where is the tab for max pain? So here's the S&P 500 index. And you can see the first things first. It's just, man, that's a high put call ratio on open interest. Meaning there's just a butt ton of put, something like over 2-to-1 ratio for put to call. So we know that the stock price at the close was 425.5. Max pain based on open interest alone is 433. But you can see most of the action is below 428. And you can see a little bit of spike at 440. But we like to look at the volume chart to see like what was the actual things being moved around a lot. And you can see that there is this kind of consensus. 430 is where a lot of puts are for tomorrow, and a lot of calls are as well. That could be, and that obviously there's so much that can happen between now and tomorrow. There could be escalation of a conflict. There can be a commodity issue with oil. There can be breaking news coming out from Tesla. Because what do we know? Tesla loves to drop random news on Thursday nights, really late at night. And most of those times in the past couple months have been price cuts, right? Not too great, not too fun to deal with because we're already dealing with another sell-off. Next, tomorrow they're going to be like, okay, let's raise capital. We're going to issue a bunch of shares. Okay, who knows? But right now it's looking like 430, but there's a lot of puts beneath this. There's a lot of puts beneath this. This is like, there's so much bearishness in this market right now. So you got to ask yourself a question, is there too much bearishness? But then you have to look at it from the other side. Like, the interest is right here. It's like, there's a lot of calls here too. I'm not saying it's more than the puts. What I'm saying right here, if you go to 433, if that's going to be the so-called max pain 433, you're going to pay out a lot of calls too. You're going to pay out a lot of calls. And I understand you don't want to pay out the puts. The question always is going to be who owns the calls. But for now, you want to look at, I would say just look at for the current price, 425 to 430 in that area. But when you get the move, right? Because this is what's going to happen. Like in the morning, let's say you get a nice pump. Let's say you get a 1% move. Let's say you're at 429.50 or 430. The thing about it is the whole point of that move is to make people close out their options because they know that it's going to start losing value really quick because they're going to expire that day. And there's a lot of single tickers that are expiring that day. It's just not just the ETFs. It's the single tickers too. So they want you out of positions. They want you close out completely. And it might scare you out of the move of what? It would be like, number one, in the morning, sharp sell-off, like huge sell-off. And then into lunchtime, pump. And then flat or sell all the rest of the day, right? And with it being OPEX tomorrow, there's going to be a lot of manipulation to try to get all these tickers to where the market needs them to be to reduce their loss or to increase their gains. So let's look at the big news that happened today that really kind of sparked the volatility. We're talking 1% swings on the SPX. So the S&P 500 was having 1% swings up and down because of what? It was Jerome Powell's meeting. So he had this, not really meeting, I'm sorry. He had like a conversational style speech. So he had like prepared remarks and then he had a sit down and they were talking about what? They're talking about, how he's viewing economic data and how he's viewing the economy. And what you really need to know is this. The speech was a little bit dovish. Sure, he was liking, how, employment is miraculously staying, unemployment is very low. People still have jobs, and he's actually 100% surprised that the labor market is sustaining itself in a very high interest rate environment. The caveat to that is very simple, is that if there's record amounts of deposits in money markets, so if you have money and you have money in bills, meaning like treasury bills, or if you have your money in the money markets, you're making 4.5%, 5% doing nothing, doing absolutely nothing. And so you can have high inflation, but there's people that have money that are making more money when they never would have made before at all, right? Because they're making 5% of their money. So it kind of keeps inflation higher. And it's a weird kind of like dichotomy. You give people high rates, but now they have a lot of money, so they're taking advantage of their high rates. It's not just corporations, it's just not banks, it's not just insurance companies. Regular old people like you and me can take advantage of these high rates with those instruments or money market accounts. Now they have more buying power. Now these people are making 5% of their money. Now they can buy more things, and now you have inflation that's not going down because people have more money. Anyways, also because they have jobs. The thing is, though, treasuries, there has never been bond volatility like there is now, especially when you compare the bond volatility to equity volatility. It's out of control. It has been out of control for a very long time, where the MOVE index, which tracks those bond volatilities, has always been higher in value than let's say the VIX. So he says Powell doesn't think rates are too high now. We're talking about long bonds that, they're going to be the highest we've seen in 2 decades, but they're not high enough for him. He doesn't really care about that. Does he feel like policy is too tight now? He says no. He doesn't believe policy is too tight. So the implication there is maybe I can push rates a little bit more, or meaning I can keep rates where they're at and then have the bond market just kill you. And that's what's happening, right? Though we're seeing the curve in the curve flatten, meaning on the short end of the short duration, yields are coming down, right? But on the long duration, it's so risky that no one wants to be in long bonds at all. It's getting no bid. And I'll show it to you in a second. Actually, I'll just show it to you right now so I can go back to the news. So let's go to the 2-year. How about that? So the 2-year, guess what? 2-year is down. Okay, it's down. I want to say it's down like 2%. I don't know why I clicked on that. Let's see here. So from the start of the day, it dropped 1.8%. Let's just call it 1.8%. So 1.8% drop on the 2-year. What about, okay, you can see it right now. You can obviously see it. I don't need to hide it from you. It was a very considerable move upwards. And let's just for fun. At the close of the day, it was up 2%. 2%. So you had a 1.8% drop on the short end and a 2% gain in yield on the upper end. Man, this is brutal for, with the TLT, which is the ETF that tracks the 30-year, it is like basically at the same price as it was when it first debuted in the market. So if you held TLT because you want to add some bond exposure to your portfolio, you've gone nowhere in 2 decades. That's horrible. That's worse than gold. That's worse than S&P 500. In a respect that the whole idea of we're going to walk away from this regime, this high rate regime, and you can every time you watch Bloomberg and every time you watch CNBC, and they bring some bond expert analysts on, you can tell all those bond people to go to hell. They don't know what they're fucking talking about. Do we even know when a 60-40 portfolio, a 60% equity, 40% bond portfolio will ever come back? If you were in that, you're dead. Your bonds would underperform the market so much, it would kill all your gains from your equity. It would kill all of them. Bonds. These people kill me. Okay, so we know Powell destroyed the market. Incoming data over recent months shows ongoing progress toward dual mandate. So this is kind of like, this is his doublespeak, where it's like, okay, I like rates higher. Oh, by the way, the data looks good. We're able to keep max employment and stable prices. Stable prices, though. I understand inflation is a rate of change, but man, things are completely unaffordable. Completely. And that's because what? That's because people are getting high interest on their freaking money. If you didn't give everyone 5% interest on their money for years, then maybe inflation wouldn't be so bad. I know it's hard to balance. I'm not saying I could do it any better, but that's happening. That's a byproduct of these rates. And let's look at the real news. So we didn't go over the financials because I just don't care. This to me doesn't really affect price action. It's just that typically after Tesla reports, the reaction to the earnings is just very, very bad. That's just how it is. Profitability, 7.6% operating margin. All these people, and we talk about this all the time, to mentally prepare ourselves for the type of business model or business approach that Elon's going to try to accomplish over these next couple of quarters. Number one, it's spent a lot of money. Number two, price cuts because he wants volume. He needs to try to keep his factories working at full tilt. So if we're not surprised, right? It's so hard to be surprised that the financials came out the way they did. There were some people in the analyst community, almost all the Tesla Hyperbulls had EPS at like 70. Well, I said what? 78 to like 81. It was someone, at like $1. And it was 66 cents. And also, the street now, so here's free cash flow. Free cash flow, we had $800 million. Where the street was thinking like $3 billion or 2 point something billion. People who thought, and I've been saying this over and over again, people who thought that free cash flow would be high, like you got to know these people don't care about the company. They're not analyzing the company at all. They're not listening to what Elon Musk says. Everyone that's saying, oh, Elon had a horrible, look, I'm not saying it was a great call, but what call does he have that's so great? Every call that he has kind of just meanders around. Like, what do you expect? The call wouldn't save the reaction to the financials because the market doesn't look closely enough at the company or doesn't believe what he wants to do will work. And what is that? This free cash flow is $800 million. I'm surprised because I was telling you guys, I was thinking it'd be like $100 billion. I'm sorry, $100 million, because I think he's going to spend every dollar he can in free cash flow. Like we had $800 million in free cash flow, but we had actually a multi-billion-dollar gain in our cash reserves. So our free cash flow is down. We're spending more money on CapEx, right? So we increased our CapEx spend. I told you guys we would. It's up. I want to say it's up like 20%, right? Like $400 million. So I'm surprised he didn't spend more on free cash flow. I'm really surprised. It's when everyone's thinking like, oh, we have $26 billion. Why didn't we just build the Mexico factory? Number one, Mexico screwed us with our permitting in the early part of the year. If they wanted us to get roped in and get kind of like pigeonholed into making the factory, they should have got all those permits done in April. And then we would have to build the factory. We would be in the midst of it, most likely. I'm sure they could just stop it if they wanted to, because he's not really interested in spending money on the Mexican plant. In my opinion, they screwed us. I don't know why everyone's so amped up to get this money spent in Mexico when they screwed us. Don't you guys know that? Anyways, I'm really happy that he's really increasing. So he increased installed capacity, right? Like, there's like a graph somewhere, installed capacity. Where is that? So here's our capacities. So we have around 2.35 million cars of capacity now, up from 2 million. So he increased it by 17, 18, 19, 20%, but without making new factories. And we've talked about this before. What we wanted to see Elon do is just increase the efficiency of the factories we have now. Now, we could say all the time, well, the argument would be this. If Elon is very sensitive to interest rates because it affects affordability of cars, why didn't he just make the factory, okay, and then build cheap cars? Well, the reality is, number one, he's developing the car right now in Austin. If you go to Joe Techmeyer's Twitter, so Joe Techmeyer is the guy that does all the drone flights over Giga Texas, he's already said they're already installing the assembly line in Giga Austin. And number two, would you want our groundbreaking, revolutionary tech in a foreign country before we even have a chance to develop it? The answer is no. That's our IP. That's going to stay in America until we get it all figured out. I don't want other people taking it from us. We've already seen what? We've already seen Toyota, Volkswagen, Ford, all the Chinese manufacturers. They're all practicing on their gigapresses right now. Maybe they don't have the exact metallurgy down correctly, but they're practicing right now. They're going to have it up and running in a year and a half. So we don't need to give people more help about what's happening. So They're already doing it now. And we don't need to build more factories yet. You know how much Gig Austin costs? $5 billion. Now, if I told you this, that if he was to spend $5 billion making another factory in Mexico, or let's say it's $4 billion, but even Berlin and Shanghai were over $5 billion. If he spent $5 billion right now and our cash goes to, $19 billion by the end of next year, do you think it would have stayed $19 billion all next year? They would have raised money. They 100% would have raised money. So if you hate what's happening to the stock now, people don't believe me. But everything we're saying is basically coming true, right? That if he sees any glimmer of an opportunity to raise money, for some reason the stock goes up a lot, and he's like, you know what? I can issue a bunch of shares, dilute all you guys, and raise $5 billion, and then I'll make the factory you guys wanted me to make. Because living through 2008, and if you watch my other videos about the UAW strikes and the global financial crisis in 2008, these car makers, they were sitting in so much debt. I mean, like tens of billions of dollars of debt in 2008 dollars, and they couldn't survive 1 month without the bailout. The bailout they got from the government, the one that everyone hates, the one that UAW had to take a pay cut for, if they didn't get that bailout immediately, they wouldn't have made it 3 weeks to the end of the month in December 2008, or was it 2009? One of those years. They have no money. We looked at Ford. If you watch my other videos again, we looked at Ford. Ford is making $1 billion net income a year. Everyone keeps talking about record profits in this UAW strike, but there's no record net income. There is no income. They're spending so much money. Is it surprising that they cut back production of the F-150 Lightning? And is it surprising that GM is pushing out their EV trucks for 2 years, the end of 2025? Something to think about when it comes to people giving Elon a bunch of crap when it comes to wanting to keep cash on hand. And all the people that are talking about, I want to buy back. Isn't it funny? It's these fund managers that are saying that, who have no assets under management, who are telling us that Elon should do a buyback because he wants his performance for the year to go up. It's the end of the year. Like I told you guys in other videos, these people at the end of the year, these fund managers, asset managers, they want gains. They need gains. Otherwise, they're not. How do you prove to your client that the fees you charge them to manage their money gave them any returns that they couldn't just get from owning the S&P 500? They would have gotten 10% this year without paying anything other than the SPY ETF couple cents fee per quarter. So kind of put that in perspective. When you hear the arguments that we have a lot of money, we don't have a lot of money. There were times Apple was sitting on $150 billion in cash, and all the investors were just begging them to take on debt or do something with it. But the cash keeps people alive when interest rates are really high. Why do you think Rivian stock is $17 a share? Why do you think Lucid is $4.30 a share? They don't have money, and they have to keep raising money because no one wants to. No one wants to invest in them. They're going to have to dilute everybody. That's what you don't want as a Tesla shareholder. To get to the point where, okay, we bought, we set aside $10 billion for buybacks. Everyone happy? I mean, $10 billion on a company that was worth last week $800-something billion. That's nothing. That's a couple percent of nothing. That wouldn't compensate for the fact that the whole street feels like that the financial situation of Tesla just got a lot more precarious because they spent a lot of money on buybacks, and now we only have a couple $1 billion on hand. We can't invest in the company anymore, and the stock sells off 10%. An amazing takeaway, other than the great, doubling of compute when it comes to their AI training. That's great. But really, it's just the cost of goods getting down to $37,500. I think you can see this continually come down even more. This is really incredible. So in the past year, since the end of last year, or the beginning of this year, really, we've seen cost of goods come down from almost $40,000 to $30,000. So basically a $2,000 savings over the course of the year per vehicle. Now, you would tell me that the price cuts okay, what about the price cuts, Mark? We've cut prices on some cars by over $2,000. And so, yes, no one's saying that didn't happen. And no one's saying that our operating margins are getting any better. By the way, operating margins did not hit consensus anyways. All the people who thought we'd have like 18% auto gross margin, like I just don't get it. It's almost like they want the stock to go down, or they're just ignorant. Energy storage. So this is kind of like a weird sticking point when it comes to energy storage. So on the call, we had I'm so sorry, I forgot the name of our new CFO. But anyways, he was trying to warn us. Now this call was, of course, very bearish and very conservative. He was trying to warn us. Okay, we had great growth in energy storage. We had good margin, but that doesn't mean we'll have it. He was like, it doesn't mean it'll be there next quarter, right? And he was trying to explain this idea of the inventory or goods in transit. I think someone stepped in. Maybe it was. It wasn't Elon, but someone told him. I think someone jumped in and was like, oh, goods in transit or inventory in transit. Yeah, because these are very large things. So you got to ship it on a boat, most likely, and that might take a while. But yeah, the call was super bearish. And so is he preparing us not to see gains in as far as the typical growth in margin for energy? Who knows? Solar is just completely dead. Completely dead. So my idea, my take on, of course, we have Cybertech. My take on the earnings call is that, number one, it just feels like that's normal, earnings calls for Elon. He was really going off about interest rates for the whole time. Especially, it was almost like that moment when I think one of the analysts asked him about margins, I believe, and then he was like, "You know what? All you work at home class." And so what he was trying to convey, he doesn't really know how to put his words his thoughts into words real quickly. But I think what he was trying to convey is that the people that work at home, he associates that with a certain level of entitlement, and then also associates that with a certain class of people that can afford to have jobs that are just desk jobs, and you can just do it at home in their underwear, right? So he believes those people are out of touch with reality, and maybe some of them are. And I think the thing about it as well is that I think a lot of people that follow the stock maybe would have benefited from the gains from holding the stock from the mid 2000 teens till now, seeing 1,000% gains. But the thing about it is, and they're rich for it, is they're kind of losing sight of what it's like to be an average, normal American person. And it's difficult. It's really difficult. So you have to give him a lot of credit that he's not out of touch, because I know people who think themselves rich. Their net worth is like $4 million, and they look at normal people with disgust and disdain, and I find it revolting. And those are the people only worth a couple $1 million. Think about the people who are worth much more than that. There's a certain level of respect you have to give Elon, that he's the wealthiest person in the world, but he can talk like interest rates are affecting him like they're affecting you and me. I give him a lot of credit for that. I give him a lot of credit for the honesty he has, that he feels that maybe that there are real, economic risks on the horizon, but he's always been wrong about it, right? He's been saying there's going to be a recession, there's going to be headwinds, or we're going to be in a storm, we're in a cloudy time or something like that. He's been saying that for like a year and a half. It hasn't really presented itself, other than the fact that, is it presenting itself just for electric vehicles? There's an argument that people would make that are making that, okay, so why is GM and Ford selling cars and Tesla's not? The thing about it, though, is that there's no transparency in the pricing, right? There's no transparency when it goes from like, what did the dealer pay the manufacturer? What kickbacks are they getting from buying a certain number of cars? Or what kind of kickbacks are they getting for being a good dealer? And what type of financing are they absorbing and subsidizing? Because, Ford Credit and GM Finance, they have the ability to kind of tweak what a customer would pay when it comes to interest rates, where Tesla doesn't have that type of power. That's something I do hold against Elon a little bit. Not having a Tesla finance arm really doesn't allow you to kind of mess with those numbers a little bit for the customer. When you need to push vehicles, you can keep the price the same. For example, if you were to sell a Model Y, and I think Holmar's blog on Twitter had a post about this, that you would pay something like $17,000 in interest. Okay, that's after cutting prices on Model Ys by thousands of dollars. Well, what if you kept prices the same and advertised low interest rates? Because there wasn't but a couple months ago, you can go to GM or Ford dealers, and they would have certain vehicles, right, that you could buy at 0.1% interest or something like that. Because that's basically a price cut. Because that the respective finance arm of that company is absorbing a loss of some sort on interest rates just to move that vehicle. So I'm happy Cybertruck's coming out. I'm happy Energy's doing well. And I know that we're building another one in Shanghai. So, if that gets up and running, can you imagine what type of growth in energy that we're going to see? And, people will look at car margins and car profit and be like, oh, I don't care about cars anymore. I care about big batteries. It's much simpler to build a big battery. And so everyone's looking at these charts with these quarterly metrics we're in a decline, we're in a downtrend. I'm like, it's obviously we're in a downtrend. But you got to remember something. Our free cash flow is in downtrend. Okay, fine. You got to realize is that we can spend a lot more money than other companies can. In a time where if they wanted to spend money, they would have had to borrow it. Okay, so what did Ford do just recently? Open a $4 billion line of credit. What did GM do recently? Open a $6 billion line of credit. What did Tesla do? Oh, we just organically gained $3 billion in a quarter. On lower deliveries, lower production, lower margin. You have to give Tesla credit. From the inception of this company, the financial aspect of this company has been run like it's like a master class of accounting. It's a master class of accounting. Every day and I'm sure behind the scenes, every day and every minute of this is like you're pulling your hair out trying to just keep this company afloat in a very difficult time for the company. But you have to give them a lot of credit. So let's go back to the chart and just end this, what I assume is a very long video. Again, I'm sorry. I'm sorry. Okay, just to recap. Okay, so we know OPEX is tomorrow, so it's going to be pretty violent in the morning. We know that typically on the Friday, which is 2 days after the earnings report coming out, that maybe what would happen is you would have a small dump in the morning, right? Maybe it drops, and we can try to draw it, and we'll try to draw it. So let's say this follows a similar pattern to what it usually does. It would come out like this. It would be like maybe a gap down at the 217 mark where it try to find a base. It gaps down to here, and I want to draw like a 2% drop. And so I would say we'll go from 217, we'll go down to 215, maybe overshoot, but kind of do this. And during the course of the morning, you get it something like that, and then like this into the end of the day. Maybe, right? So you kind of get people out of their calls in the morning, or just, scare people from going too short. And then you pump, and then you go short. So it's going to be interesting to see what happens tomorrow, but that's one way that could happen. We can look at the futures to see what's happening in the futures, and it doesn't look all that great. Pretty flat in the futures. So it's early on in the night, so this might not be really anything. But know what? One thing is that, rates got to a really, really, really desperately high point. Where do we think that rates would stop? I mean, for the long run, we thought it'd be around 5.3%. But you can see here in the evening hours that it kind of gapped down. And so we have 0.4% drop on the long bond. Something to watch out for. But so this is what could happen. This is what typically happens, really, with Tesla stock. Try to think of a catalyst, is that the overall market pumps really hard because the market's trying to achieve, if to get the S&P 500 to a 1% gain, maybe Tesla goes up with it, a couple percent. And what you want to see is what? When we define the lower EM, we're trying to anticipate what the market is comfortable selling options for. Meaning that if they were to sell something outside underneath $227, maybe they don't want to pay those puts out. So in the bullish scenario, you want to get back into the EM, and my EM might not really match other people's EMs. I understand that, but at least trying to getting above 227 would get them to the point where, okay, I made most of the puts worthless, but the reality is, when it comes to a very bearish kind of a Tesla momentum, we saw it during the July earnings report, that even if all the puts on Friday were in the money, it just keeps selling, right? It's really hard to beat momentum. We talked about that yesterday. But anyways, thanks so much for listening, guys, and have a great night. Bye.